Peter Hug joins us this Thursday. Peter, good to see you again. Welcome back from your mountain retreat.
Thanks, Daniela.
And what a reality you've come back to, Peter, since you've left. There's been quite a shakeup in the gold market. What are you seeing?
Well, I think we saw it start last Thursday. My commentary, if I remember right, again, I've been sitting up in the mountains, not exposed to too much, but my commentary Thursday morning and then again reiterated on Friday was, with the ECB move to lower interest rates and then Draghi immediately suggesting a QE program, albeit not effective until sometime in October. That just took the edge off the currency market and created a significant flow of funds into the U.S. dollar, which is generally a headwind for the metals. So the 1265 level, it took a while, but overnight, over the weekend, it broke through 65. And, we find ourselves this morning down, testing the next support level of 1240. And, what it is, I really believe is a perception that, U.S. rates will rise and the U.S. economy is doing much better than Europe. Both of those statements, I think, are accurate, but I still believe they're premature. And, so you have capital flows moving into the equity market and to some extent the bond market from a safe haven perspective. And, the metals without the physical offtake that has been lacking seriously for the past 3 months just succumb to the selling pressure.
Peter, you mentioned the U.S. economy doing better than the European one, but you're still not sold 100% on the U.S., correct?
Yeah, I think it's tepid. And, I think, the talking heads that are expecting the Fed to aggressively raise rates in the near term, I think they're off the mark. I think Yellen not only needs to concern herself with the U.S. economy, which again I think is tepid. One week the unemployment numbers. If just look at the employment numbers from last week, they were miserable compared to where consensus was expecting them, and housing is sort of sideways right now, and the middle class is not experiencing this economic boom that that congressmen are speaking of. This is basically the top 10% of the American people that might be experiencing some affluence over the past 3 or 4 years.
Peter, let's talk numbers now. Silver breaking through 1890, a triple bottom support line for the past year. What are you seeing on the silver front?
Yeah, silver's difficult here. 1890, held well over the past year and a half, tested it 3 times, and now it's through that level. I'd be very careful silver here. Again, there's little industrial demand for the metal right now. There's very little investor demand, even at a breach of $19. So I'd want to see silver firmly establish itself again over the 1890 level before I would take a position for a bounce. But below this level, there's potential of seeing silver,
Don't say it, Peter.
down under 18. And the reason I say that is if you look at a ratio basis, the last time silver was at 1890, gold was at $1,190, and gold's at 1240-ish. So even if you took 2 ounces of silver to an ounce of gold, you add another $40 to gold just getting down to support at 1190. That would indicate a silver price probably at or under $18 an ounce. So I'm a little nervous at silver at these levels.
So not yet a potential buy, Peter?
Again, are you a trader or an investor? I like this market medium to long term. And if you don't have a silver position, it's not a bad time to enter the market. If you're long this market, it's time to reevaluate your position on a percentage basis and recalibrate your portfolio. So if you want to hold 10% of your assets in silver, and now with the drop, your assets are down, or your silver assets represent 7%, you need to recalibrate by 3%. So it's really how you want to look at this market and what your motivation is behind it. If you're a trader, I'd be not tempted to go long this market until I saw a firm break up above 1890.
Peter, last question for you. Lowest U.S. gasoline prices we've seen since 2010, and they're set to get lower. Any correlation with what we're seeing on the gold front here?
Yeah, I think, everybody's talking about inflation being around the corner. And if you look at the ag complex, food pricing is starting to come down, and I think it'll continue to come down. You've got energy pricing down well over 10% over the past 3 months. I mean, this is all non-inflationary and all indicative of more consumer optimism coming up and possibly more consumer spending, which again would therefore translate into a potential increase in the value of the equity markets, which again will take capital away from the safe haven assets and put pressure on the metals. Now, remember, we've still got some geopolitical risks with Ukraine. You can't trust Putin, and some of the issues in the Middle East. Argue that you should still maintain a position in metals as an insurance policy. But from a trading perspective, these markets still continue to look heavy here.
All right, Peter, that's all the time we have for today. Thanks for joining us. We'll see you next week.
Great. We'll see you then. Thank you.
And thanks for watching this edition of For Pete's Sake. We'll catch you tomorrow.